Tamarack investors, thank you so much for joining us on this webinar where we're covering the private credit fund in partnership with Aspen Funds. This is our first time bringing an income-focused fund to our investor group, and we're really excited to be launching this. And we made the decision about 6 months ago to bring a income-focused fund to our group because in my conversations with all of you, I've been seeing that, while you love our multifamily investments, you also have investment goals that those offerings are not solving. And so if we look at the investment profile of one of our apartments, we have pretty much 2 years during the 5-year life cycle where we're spending a lot of time and money on renovations and improvements. We have higher vacancy and rents haven't really been increased up to our pro forma rates. So there's no cash flow in those first 2 years to distribute out. And then once we do stabilize it in the years 3 through 5, the cash on cash return is generally a little bit more modest, about 6 to 8%, which isn't bad, but also it can be disrupted. It's less predictable because if we have something like higher vacancy that we weren't planning for, or we have unexpected expenses, that's going to eat into our ability to distribute while we build those cash reserves back up. And a lot of folks are in retirement, near retirement. They want to have a bit more predictable income sources that pay them month to month. And they also want something a bit more exciting than a US Treasury that offers something like 4.5% returns. So about 6 months ago, we started our search, hearing a request on what can we do to help solve this problem. And we looked at a lot of different operators. Our team is focused on multifamily. We aren't equipped to start issuing our own income fund. So we looked at those we'd want to partner with who have a lot of experience and expertise in the area and a good track record. We found a handful that we liked and we started vetting out, and that led us to Aspen Funds. So I'm here with Ben Frazier, who is the Chief Investment Officer of Aspen Funds. And I've had a really great time meeting with Ben and his team in person. We were actually just down in Austin the other month doing a mastermind that Aspen Funds hosted with a lot of other industry experts in the investment and capital raising space. We're down in Austin, which of course meant that we had to have barbecue, and they hosted it at a country club / indoor gun range. So we got to shoot off some guns too. It was a great way for us to get to know his team as people and see if they're individuals we want to do business with. They passed that with flying colors. And so we started the technical feasibility, looking into the financials, the strategy, the investment committee who's going to be making these decisions. And we feel very good about the team in place and are excited to be joint venturing with them. So with that, Ben, thank you for joining us. If you want to say hi or anything, please.
Yeah, well, thanks for having me on, and just very thrilled to get to partner with you and your investors. And we see the same thing, right? A lot of investors that are at a different stage of their investing journey want more predictable cash flow, want to take less risk, and the market's rewarding those investors right now. It's a great time to be in private credit, really great risk-adjusted returns. And so I'm really excited about this fund. This is a core vertical for our team and our company, and excited to dive into this with you.
Excellent. So before we get into the fun stuff, we do need to hit on the disclaimer. This presentation is just informational. We're trying to give a lay of the land on the fund, who manages it, what the strategy is, and what we're actually lending into. We also have the private placement memorandum and subscription documents, which are going to be everything you need to dig into the full package to evaluate your investment decision. So with that out of the way, investment highlights, just to give you the 30,000-foot level. This is an open-ended debt fund. That means that it can continuously take in new investor capital and then continually issues new loans to real estate operators. And as those loans mature, they can recycle that capital and issue out new loans. In the interim, they're also taking the monthly payments that come in from those debt payments and distribute that out to the investors. The strategy and asset class that we're investing in here is mezzanine debt and preferred equity. So those are two terms that might not be familiar to you. We're going to hit on what that means exactly in the following slides, but just know that it's not primary debt and it's not equity. It's in between. The asset classes that we're lending into on this is real estate in the industrial, multifamily, and retail space. The target returns and historical returns have been between about 11 and 12%, depending on which asset class you're in. The entry-level asset class is Class A with a $50,000 minimum, and then if we do hit if you hit a $500,000 investment amount, then we do discount our overhead fees to increase that return. Also, what's really nice about this opportunity being an open-ended fund is that members can elect really at any time to reinvest their distributions if they don't need that cash immediately. And that goes back into their ownership of the fund and compounds the returns to make those returns even higher. Now, a unique thing about this is that it is a Reg D 506C filing, which means that this is restricted to only accredited investors. Historically, on our multifamily investing, we do what's called a 506B, which means that we are allowed to admit a certain number of non-accredited investors as long as they're pre-existing relationships. This is a bit tighter, and so we do have to have verified accredited investors in there. And right now, we're looking at our first tranche of being $1 million. So after that, we're going to put a pause on raising additional capital through the Tamarack vehicle. We're doing this because we're working with Aspen to align the new capital into the fund with the deals in their pipeline to make sure we try and make that as efficient as possible and to try and minimize the amount of cash they have sitting in the fund, working unproductively, just sitting there. One of the really attractive things about this investment is that we have a 2-year lockup. Most of our apartment investments, it's a 5+ lockup period where you're along for the ride. Because this is open-ended and the different loans are maturing and new capital's coming in, there is the ability to redeem. And what Aspen does is you put in after 2 years, if you want to redeem, put in your request, and they have a 90-day redemption period. There really is it's called best effort. So if they can redeem you immediately, they will. If they have other obligations, like a new loan being issued and they need to retain capital for that, they need to match up with the fund's best interest. But it's much more liquid than our traditional investment offerings, which is also another nice value add. Distribution timing. So after a 90-day deployment period, our investors receive monthly distributions on a 6% preferred return. So that means that every month you get 6% of your investment, divided by 12, distributed out to you. And then, as we'll see as we get into the lending strategies in there, there's also a large profit upside. And so what that means is that once a quarter, we look at what have been the profit proceeds from these loans, things like origination fees. There's accrued interest that can get paid off if a loan matures. There's exit fees. And we're able to pool all this together and do additional profit upside distributions. So between the 6% preferred return and the profit upside, we're targeting between 10 and 12% returns. So we kind of alluded to mezzanine debt and preferred equity. What does that mean? So we're going to look at capital stacks, and every real estate deal has a capital stack. That simply means that there's different sources of capital to fund an acquisition of a new project. Think of it as we can look at just even a simple house purchase, right? If you go to the bank, you're going to get a loan, and then you're also going to put a down payment. So in commercial terms, we call this common equity, which is essentially the investor owner's equity down payment. Generally, it's around 25% for typical deals. And then there's a senior debt. So for our apartments, we really just keep it this simple. We go and we work with a credit union or a bank and we get a primary loan on it. And we raise the equity capital from our investors. We close on the deal and we operate it. The senior debt is very simple. They get a fixed and defined return, generally 6 to 7%. They get paid first. If they don't get paid, they can foreclose, and they don't share in any upside on that. So that means that they are on the bottom of the capital stack. They have the lowest risk and the lowest returns. Common equity takes all the risk. If it can't perform, if the debt's not paid, they get nothing. But in return, they also get all the upside. So this is kind of your standard capital stack for a real estate deal. Depending on the situations, we also get into more exotic and specialized areas where depending on the circumstances of the deal, the operators might try and secure something called mezzanine debt. It's called mezzanine because on a building, there's like the ground floor and then, the up floors, and the mezzanine is typically the second floor. It's just an analogy for this is second position debt. So it still has all the rights and security of debt, but it sits in second position to the senior debt. So if things go really off the rails and poorly, and for some reason the property is sold, there's not enough proceeds to pay off the mezzanine debt, the senior debt's still going to get paid off before mezzanine debt participates. Now, Ben's also going to be talking about how they structure their deals with enough equity on top of it that this is a very low risk. But again, mezzanine debt does have a little bit additional risk in there because it's not senior debt. But as we'll see, it's compensated by what I think is very fair returns for that risk. On top of mezzanine debt, if there is mezzanine debt, is preferred equity. And this simply is, it technically is equity. It sits before common equity. So there's covenants in the operating agreement to make sure that the preferred equity always gets paid off before common equity. If there's distributions, preferred distributions defined, then preferred equity gets all of its distributions paid out before common equity ever gets a distribution. And there's also circumstances where preferred equity can participate in upside on the sale too. The nice thing about preferred equity is that because it is debt equity in the project, we can also get depreciation loss allocated to us, which technically debt cannot have that allocated because it's not a equity owner. Anything to add on that, Ben?
No, I think you did a great job. Usually, I would just say as a point of clarification, it's one or the other in a single deal between mezzanine debt and preferred equity. So the stack here is helpful to see kind of the priority of repayment. But in most cases, most deals have just senior debt and common equity. In some cases, like the deals we do, there may be preferred equity or mezzanine debt. And there's pros and cons of both. And one of the things we can get into in a little bit, but our fund actually passed through significant tax losses to our investors, despite being an income-focused fund, for 2024. So definitely some benefits that are being passed through from the tax side.
If we could actually hit on that real quick. So equity gets depreciation loss because the IRS allows us to depreciate on a certain schedule. Real estate's really benefited over the past number of years because of the 2017 tax law that allowed for bonus depreciation. And so right now, Ben, I believe that investors were getting about 20% of their investment into depreciation loss. Is that accurate?
For 2024. Yep.
For 2024. And literally today, the House passed through the current administration's tax bill, which is looking like it's going to bring back 100% bonus depreciation. So that 20% tax advantage should be increasing on everything, which is really good news for these investments.
Yeah, great. Absolutely. Okay. Absolutely.
So, Ben, if you could take us through the portfolio statistics and kind of how the fund looks right now and where it's going.
Yeah, absolutely. So a little more kind of background on Aspen, and we'll get to this in a little bit, but I think it's helpful to kind of see how it connects to this fund. We started in distressed debt and non-bank, lending about 13 years ago. So that's really the origin story of Aspen. Actually, is finding unique opportunity initially in residential debt, coming out of the great financial crisis, and started writing open-ended funds. Some were more growth focused, some were more income focused, but this has been a core part of what we've done, of building the expertise, the deal flow, seeing the market opportunities for over a decade. And what's happened is over the past few years, the opportunity has actually shifted a little bit from more residential to more commercial. And we can get more to that if you'd like, but the opportunity right now is really in commercial real estate. And so what we've done is we started doing a lot of these deals for a few years in that legacy fund, but decided to pull it out into a new fund at the beginning of last year to allow us a more flexible program and platform to go and make these types of investments and loans into what we think is going to be a very big opportunity over the next few years. And so we've been doing this for a long time. This fund is newer, but it's really a continuation of a lot of what we've been doing in our past fund. And so all that to say, we've raised, and these numbers are slightly outdated because it's from Q1, ending of Q1. We are actually close to, I think, $23 million in capital funded. We have closed 8 different investments in the fund so far. And I'll go through some of the stats here, and I'll try to explain what these mean and why it's important. But when you're looking from our perspective, we kind of have this hybrid viewpoint. We want to look at what does it look like from a debt standpoint, from a lender's standpoint, and does it pass all the tests that we want to see? Then the other side of it is, does it have enough of a solid business plan and enough of a sound thesis to actually benefit the common equity investors? And in a worst case scenario, if we had to take the project back, which in nearly every circumstance, we have rights to take over control of the project, can we comfortably operate it as operators? I'll get into that in a little bit. But one of the things we look at from a capital protection standpoint is our leverage position. And so we have LTV and LTC. And the difference there is really loan to value is what's the last dollar that we invest into a deal. We're usually coming behind the senior loan. So it's the combination of the senior loan plus our loan or preferred equity investment. And the last dollar of that investment, where does that land relative to the underlying value of the property? So we like that to stay under that 70% number or right around there. And then loan to cost is day one costs all in the project, right on 75% is where we like to hover. So that means we have 25% equity coverage above our position that would have to get completely wiped out before our capital takes a hit, right? And that's the kind of nice risk-adjusted return that Casey was talking about that we like to see, where we're earning a really great yield and we're not taking the same level of risk as the common equity investors. The other thing that's important here is we have liquidity in this fund, right, through our redemption program. We have a 2-year lockup. And the reason we're comfortable doing that is we have a weighted average maturity right now of just over 2 years across those 8 investments. So that means every 2 years right now, the portfolio will churn 100%. It means all of those deals on average will churn, meaning they'll get paid off, but to redeploy the capital. So that creates a lot of capital velocity that gives us comfort in being able to offer liquidity and then continue to reinvest back into new deals. And right now, this is a beautiful number because this shows you the power of what we're doing in these types of deals. Is our weighted average gross, what we call yield to maturity, or basically IRR at the fund level on the investments that we've made, is 17.66%. That means before, at a gross level, before any fees and expenses of the fund, we are earning 17% on the investments that we've made so far. And so it shows you the kind of yield that we're able to achieve with relatively less risk. Right now, we are at a lower deployment efficiency than we will be once this fund kind of stabilizes. So you can see that on the left there, we're at 79%. And part of that's because as we're ramping up the fund and the fund size is growing, we're retaining more cash to go and negotiate deals. And it's a little bit of chicken and egg as we, are trying to get the cash ready to fund the deals that we have to fund. The great thing is we're getting really, really tight on our chickens and eggs right now, where the cash that we have is pretty much marked or earmarked for the deals that we're going to be funding the next quarter or so. And then we've also just got a line of credit on the fund. And what that allows us to do is basically be, a big line of credit like you've had on a home equity line of credit, or even a big credit card for your business, where we can go and use the fund assets to get, pretty cheap financing from a local lender that we know pretty well. And they'll allow us to go and make these acquisitions, and we backfill it with more equity. And what that does is reduces cash drag. And Casey, as a finance guy, knows what that means very, very well, and we can get to that in a minute. But as we reduce the cash drag, the yield will continue to go up, efficiency will go up. And so we're very excited about where this fund sits right now and where it's headed.
Yeah, that's great. And for any non-finance people, cash drag is simply, and Ben hit this high level, but you don't want cash in the fund just sitting there in cash. It's not productive and it just dilutes out the returns for everybody. So it might be a 17.66 gross yield, but if 20% of that's cash, then you're just diluting that down. And, Ben and I have been talking for the past 6 months, and in that time is when they got the line of credit. And that's what really excited me was you could actually get deployment efficiency to 100% or even above 100%. Now,
Yep.
if you really wanted to magnify returns, and this is not in the strategy here, you could actually get a fixed line of debt of say 20% of total capital funded and leverage that up. We're not trying to leverage, we're not trying to swing for the fence here, but using that line of credit to optimize the deployment efficiency and smooth out funding new deals and raising the capital is going to be helping magnify returns down the road.
100%. Yeah, great explanation.
Okay, so Ben's going to walk us through like what is this? We talked high level we're funding deals, but how does it actually look in practice to have a mezzanine or a pref equity loan that we issue, and why would anyone want to take that? There's a lot of reasons. Real estate is a very complicated ecosystem, and coming in with a solution, I think Aspen uses the term a dislocation in the market, which I love, allows us to get outsized returns for the risk that's going on. So we got 3 case studies we're going to hit on, and yeah, Ben, take it away.
Yeah, I'm excited. And these are some great case studies to give you an idea of the types of deals that we're doing. And before we get into the specifics here, I think it's important to understand what's driving the need for our capital, right? Well, there's a few things. One, there's a lot of stress in the commercial real estate market in general. Now, we don't do distressed investments or distressed lending. That's not what this fund is for. But what that has caused is a lot of stress in the market and the lending market. So lenders have pulled way back. Not only is their risk appetite lower than it was a few years ago, where they're not willing to maybe do the same deals they were before, but they also are having issues with payoffs. They actually can't go fund new deals because the old deals that they have are not getting paid off or refinanced. And so that restricts their ability to lend new capital. On the other side of it, equity's been harder to raise because now you have a bigger gap of equity you got to go raise, but it's even harder to raise equity right now than it has been for the past few years because of some of the turbulence. And so you kind of have this sweet spot in the middle where we can come in and our terms are going to seem pretty high. Like why would a sponsor or a borrower want to take the terms of our money? Well, the great thing is we're quick to close. We have committed capital all ready to go. Right. And we're also accretive to their common equity, which means our capital actually makes their common equity returns better. And so we can get through some examples here and show you. And the other kind of thing I want to explain too is this has been an existing part of the investment landscape for a long time. Private credit is not a new idea. It's been done for many, many decades. What's interesting right now, and where we're finding a really unique sweet spot, is in the sub $5 million funding area, because most of the big players in preferred equity, private credit, they won't go below, most won't even go below 20 million. There are some that will go to about 10 million, but that's even a much smaller group. And to go below 10 million, they're not willing to do that. And so it creates this huge gap in the market that we can play in and actually command a much higher yield than we would if we had to go play in the bigger numbers, because it's very efficient, because we have a single fund, it's open-ended, and these are middle market deals that we know very well. It's very efficient for us to go do that and command those yields. So let's get into some examples here. This was a gap funding deal. So this was a sponsor that we've worked with several times before. We knew them very well. They're purchasing a 94-unit apartment complex. This one was actually in our backyard in Kansas City. We knew the area. And he called me with about 30 days to close, and he said, I don't have enough equity. I know I'm going to have it. I have a big IRA investor that's trying to transfer his money and move it over, but they're taking forever, so I'm not going to be there in time. Right? We've done an IRA rollover, you know that pain. And he said, I just need a short-term loan to close this deal, and then I'll pay you off within 90 days. That's exactly what happened. We were able to put a secured lien on this property behind the senior. He only needed $500,000. This was a smaller investment, but it was a 90-day loan. So we're able to earn 2.5 points, which is upfront fee, 12.5% interest rate. Our last dollar in was at 75% loan to value. So he was already had 25% equity above our position at that point. And it was a 90-day term. If he didn't pay us off, we had other fees, extension fees that he was going to have to pay that would increase our yield and continue to encourage him to pay us off. But he did. He paid us off in 90 days. And then we were able to use that cash to recycle into new opportunities. So, gap funding is a common thing that's always a need regardless of the market cycle. And this was a great example of that.
Yeah, I mean, you talk about motivation. We've never been in this position where we needed to get gap financing on a deal, but you can imagine a sponsor here. They've put up maybe $100,000, $200,000 of earnest money that's gone hard, which means if they don't close on time, that seller can just take their money and walk away. We're out here solving those problems with motivated borrowers under very good terms for us. So I love this.
Yeah. This is another great one, and I love these. We're actually doing another one right now, in looking at in the fund, and this is a loan assumption. So these are deals that are, I think, pretty attractive in this current environment. So here's the story: the sponsor was purchasing an asset, multifamily apartment building, and the kind of big headline news on this one was they were assuming an agency loan. I believe this one was from Freddie. Of 2.94%. That was the interest rate that they were assuming, which means they step into that loan. They're assuming it from the current seller, and they get to retain that interest rate until the maturity, which is, I believe, 5 years from now. It's great, right? Who doesn't want yesterday's interest rates, right, on a good asset? The trade-off of that is because this seller actually refinanced several years prior, and they were amortizing, which means they're paying the principal down. The loan to value is actually pretty low. It was 45%, which is very low for a commercial real estate. And so we were able to bring in some more equity, or preferred equity, behind the agency lender. They raised the common equity, and we brought $1.5 million to the table. They brought in the rest of the equity. Our last dollar in on this one was at 60%, right? So they had 40% equity coverage above our investment that was protecting our position. So pretty low risk, right, from a capital protection standpoint, but we're still able to achieve really great yields. We got an origination fee. We're getting paid 8% current annualized interest. We're accruing an additional 6% on top of the 8%, compounded monthly. So it's actually compounding and creating additional yield. We get paid when they sell, when they pay us off, additional 1%. And this is a 3-year term. So we're going to get paid off in 3 years. And the great thing, if they don't pay us, if they're in default, we have what's called forced sale rights, or drag to market rights. That is a right that we've put into our agreements where we can force them to sell the property to pay us off because they're in default of our agreement. So kind of the ultimate detonate button, right? We don't ever plan to use it, but if we have to, we have that leverage to do that in the deal.
Yeah, and I want to touch on too, I talked earlier about how there's a 6% preferred monthly distribution, and then every quarter the overall fund profits are pooled and the profit distribution goes out. And this deal is a perfect example of how that works. There's 8% current payments, but there's also this accrual. And so when the loan gets paid off over 3 years, 3 times 6, that's 18%, all of a sudden gets injected into the fund. You can imagine a portfolio of these timings happening, over the course of the life cycle. This is where the profit comes from to get up to those higher returns.
Right.
All right, last example here in the portfolio.
Yeah, so this was an acquisition of an industrial Class A building outside of Atlanta, Georgia, and Waycross. And this was a really cool deal. So this came through to us through a well-known broker we worked with a lot on other projects. And And this was, I would consider, an institutional level sponsorship group. They've been in the business for over a decade. Some really heavy hitters in industrial, have done a lot of big projects. And this was just a project that they couldn't pass up. What's so attractive for them, their standpoint, is they were acquiring this building from the tenant who is relocating, and they don't hold the real estate anymore. So they sold it at a $52 per square foot price, which in that market is at least 30% below replacement cost, right? So to go build a new building of the same type, you'd have to pay 30% higher just to go build a new one. And so they had a really great basis on this. And so bringing in our preferred equity helped increase their IRR, also reduce the equity they needed to bring. And on this one, we have a $2.1 million investment. We have takeover rights and forced sale rights. So not only can we force them to sell, we can also take over the project and basically fire them as the manager and start making decisions at that point if they go into default of our agreement. Our last dollar in is at 75% loan to value, so 25% equity coverage on this. And we're charging about 16% all in yield, not including fees. And the idea here, it's a short-term business plan. They got a really good value. They're going to release it, retenant it. Once they stabilize it, get the new leases in place, they're going to sell it. So they expect this to pay off. We actually just got word today that we get monthly reports from all of our borrowers that they have 3 interested user buyers right now that are in late stage due diligence. This one might get paid off quite a bit sooner than 2 years, but really like this deal as well.
That's excellent. And, while we love 8% current, 8% accrued returns, if you also look at the origination and exit fees, getting a quicker turnaround just juices up those returns higher. So it's just a problem of reissuing that loans out. So, Ben kind of hit on this. This fund started in Q2 of 2024. And so we actually have historical quarter performance for the last 3 quarters. As you can see, it's averaged about mid 10%, depending on Class A, Class B. And Q4 and Q1 did drop down a bit, and that was a result of cash drag as the fund was growing. Now we have 2 reasons why this is going to get minimized, and those returns are going to stabilize where we want them to be at. One is where we talked about that flexible credit line is going to get that cash efficiency up much higher. And the second is that as the fund grows and continues to grow, the portion of cash sitting there we're getting ready to be deployed is going to be more minimal relative to the overall fund size. So at the worst case scenario, what we're seeing right now, we're still at about 10% and expecting that to jump back up with the deal pipeline.
Yeah, we got a lot of deals in the pipeline. We got several signed term sheets, and we also had some expenses, kind of first year expenses that are about to not be impacting the financials anymore as well. So we're a really good inflection point to start to tick up to some of those kind of 11s, 12% numbers that we like to see.
Yeah, that's a good point. So the startup costs of the fund were amortized over the first year, and so those are dropping off. So really, it's advantageous to come in now after those expenses have been eaten away at. So we also want to explain the management team and then their track record to understand, who Aspen is. So, Ben, take it away.
Yeah. So these are 2 co-founders. So Bob Frazier, Jim Mafuccio, they started Aspen Funds in 2013. So we're in our 13th year of operation now, and really unique backgrounds, but both very successful entrepreneurs and saw an opportunity coming out of the great financial crisis to buy distressed debt at pennies on the dollar. And that's really what led to the formation of Aspen Funds. It was at that point just an opportunistic opportunity where they got some friends and family money, did very well. But continue to see opportunity, continue to see what the market was giving, and want to take advantage of that. And so began to really scale the company. I joined about 8 years ago, and my background is in commercial banking. I was a commercial lender and underwriter before joining the team, and I lead all of our capital markets. And then our other 4th partner is Dan Schulte. He's a CPA, former CPA and an attorney. He's our COO and is on our investment committee as well. So yeah, I'm one of 4 partners, and you can see there's a lot of gray and white hair around me with a lot of experience just across our partnership team. We have over 100 years of experience of investing in real estate experience. So a lot to bring to the table. And like I said earlier, a core part of what we do is credit, debt investments. That's been a core part of who we are. It's obviously my background as a banker, and very excited about getting to work with Casey and his team.
I'll also add, Ben is the co-host of Invest Like a Billionaire podcast. I've been listening to it for a while. It's just a very entertaining and insightful listen to on different economic topics and their investment strategies. So if you're a podcaster, go check it out. I've had a lot of fun listening to it. We also wanted to highlight, Aspen's track record in credit and also in real estate equity ownership and operations. I think it kind of highlights that while this is a year-old new fund with a new strategy, we're drawing from a very deep well of talent and experience.
Yeah. So, we have several full cycle funds there. That one started 2013. That was the very first fund. And then we are actively operating 4 other funds that are credit focused. We've since inception have purchased over 4,500 assets. We've deployed over $100 million into these kind of credit assets. A lot of this is the mortgage notes, but also a lot into the commercial as well. We've invested in all 50 states through the portfolios over the years. We've distributed back to investors. I think that number has now crossed $50 million in distributions back to investors. And we're vertically integrated. So we do a lot of the servicing, we do asset management in-house.
And that's on the credit side. And then if we look at the real estate side.
Yeah, and I think this is a great way to kind of round it out, because not only do we have a deep expertise in credit as lenders, we also own and operate a pretty sizable portfolio. And so we're actually up to probably 400 million on the real estate side now, managing over several thousand units across multifamily, industrial, retail, self-storage. And the benefit I think this brings for this fund in particular is one of the core things we look at when we're underwriting a deal for the credit fund is, do we also feel comfortable in a worst case scenario that if we had to take it back, we could reasonably operate it? And that is a core part of our analysis, right? Because the ultimate leverage point that we have is we're going to take over the deal with these sponsors. And if we have to use that lever, we're going to meet it and we can actually do it. And so we have a deep experience. We have a whole asset management team and accounting back office team that manages all of our real estate right now. So we're already staffed to do this. It's not a core part of what we want to do, but it adds that extra comfort knowing that we could step in and take over a deal that maybe wasn't performing that to our expectations and continue to protect investor capital.
Yeah, this is a big factor of what got me excited also about partnering with Aspen. So it's good to see that they're multifaceted and deep bench. So then the last thing is, where's this fund going? Ben and his team are working diligently to be screening and constantly bringing in new opportunities in here. They have over $20 million in the pipeline. But yeah, Ben, what are you seeing out there for new opportunities?
Man, it is as full as I've ever seen it. I think it's just, like I said, it's the golden era right now for folks like us in the space, because there's just a huge need for capital, right? And the lenders have pulled back, equity's harder to raise. There's a lot of dislocation in the capital markets because a lot of lenders, I should say, don't know how to underwrite to certain assumptions, right? With the treasuries, what are they doing? And where's rent growth going to be? And there's just a lot of discombobulation that's causing pullback, right? And that's opportunity from our perspective, because we have very clear theses on the different verticals that we're in and why they're going to be good places to be. And then not only that, we're lower in the capital stack, so our risk is that much lower. And we're underwriting these deals. So deal flow is great right now. We have several term sheets that have already been signed that are moving their way to closing. Deals that we'll about, and Casey will talk more about here soon as we get closer to closing. And I mean, it's, very, very exciting. I think last quarter we did an update just a few weeks ago. I think we evaluated it was something like 75 different deals, and we funded 2 last quarter. So there's just a whole lot of deal flow. We're very, very particular and picky on what we want to invest in. And we have a full committee that approves all these deals. So it has to be unanimous consent. We have 5 voting members. It's all 4 partners, including myself. We've also hired a third-party consultant, a very, very experienced debt broker. He's actually a former Swiss banker and places about $1 billion of debt a year. So very, very experienced, brings a wealth of knowledge, and everyone has to be on board to move a deal, even to term sheet. So yeah, we feel like there's a great opportunity. We've got a lot of deal flow coming. We have a lot of capital in the queue. So we feel like this fund is going to be in a great spot through the rest of the year.
Yep. A lot of deal flow, a lot of capital to deploy out. That kind of leads us into our investment timeline. So this is being recorded Thursday, May 22nd. Next Thursday, we're going to have a live Q&A with myself and Mike Sullivan, who is on Ben's team. I've got to know Mike very well. Great guy. You're going to love him, and he can also answer any of the questions you guys have. We are going to be open for accepting capital by June 15th for the initial tranche. And again, that initial tranche is $1 million. Ben and I have been working together on what are their capital needs to match up with their deal flow. We don't want to increase the cash drag even more. So, really, we're just limiting this right now. There's going to be more opportunity down the road, but that's going to be in coordination also with the Aspen Capital team's deal flow and getting things lined up. So with that, join the live Q&A. I'll be sending out to our list we're going to do it probably in a webinar format, just to make it easy to get multiple people in there. It's going to be open doors, so if you can't make it till 5, Mike and I'll be hanging out in there. Come and go as you please. We can answer any questions. If for some reason you can't make it to that Thursday 4:30 p.m. Q&A session, reach out to me. You got my email, casey@tamarack.rei.com. I should also have my number. And yeah, let's connect, answer any questions. And yeah, we couldn't be more excited to be launching this. And thank you guys for taking the time to hear what we have to say on this current income fund opportunity. So thank you.
Thanks.